I think perps are going to eat the world. Personally, not financial advice.
I also read that MSTR is going to get tokenized on chain. And MSTR, of course, is an equity wrapper of Bitcoin, which is a commodity on chain. So this is evidence that we live in a simulation. I'm waiting for the sky to crack open. They say, congratulations, the simulation has ended.
And we have here, ladies and gentlemen, the sitting president of the United States actually engaging in forward guidance, and the market seems to be paying attention to him, which is totally surreal.
He's basically saying, now owning crypto is no longer a speculative position. Failing to do so is. So, and that makes sense. I mean, if you just look at the total market cap of the crypto space, or Bitcoin specifically, and you hold a globally diversified portfolio, it's telling you should have a couple percentage points in crypto. Hi, everyone. Welcome to Bits and Bips, exploring how crypto and macro collide 1 basis point at a time. Today, we'll be talking about Perps, tokenized stocks, Coinbase, and Robinhood. We'll obviously get into a little bit of macro as usual. And there will be some updates about impending launch of new crypto ETFs that could be coming as soon as this week. But first, some quick intros. I'm your host, James Seifert, TradFi Archmaester, Lord of Bloomberg's End. Here with Ram Alawalia, Maester of Wealth, leader of Lumina.
How's it going?
Also joined by Noel Atchison, High Seer and keeper of the Crypto is Macro Now newsletter.
Hi, everyone.
Today, we're also joined by Thomas High Envoy of the Jito Markets.
Hello.
We're here to discuss the latest stories in the worlds of crypto and macro. Just remember that nothing we say here is investment advice. Please check unchaincrypto.com/bipsandbips for more disclosures. Before we begin, let's take a minute to hear from the sponsors who make this show possible.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO memo. Carefully consider the extreme risks associated with crypto before investing.
All right. Before we dive in, Thomas, why don't you tell our audience a little bit about yourself for those that don't know who you are, and give us a 1 or 2 minute spiel about what you're doing, and then we'll get into the topics of the day.
Sure. Hi, everybody. It's really great to be here. This is a brand new format for me, so I'm curious to see what happens. I am the Chief Commercial Officer at the Jito Foundation. Everybody here, I think, is pretty conversant with who Jito is. Before that, I've been at Jito for about 3 months, since the beginning of April. Before that, I was at a little trading firm called Jane Street. I was there for 22 years. Did a bunch of different things. I was part of the team at Jane Street that started looking at crypto in 2017. And I was part of that team until Jane kind of resized the business in the second quarter of 2023. And at that point, my last 18 months at Jane I spent actually helping us build out our exotic options business. So went from working with crypto people to like negotiating ISDAs with banks and trying to, get them to lay off risk with us. So
when you say resize the business, can you explain that a little bit more? When Jane resized?
So Jane was at its peak. Jane ran a very, very substantial crypto business, which included all different types of products, like trading spot and perps and derivatives. We also had a DeFi program. But in the second quarter of 2023, this was maybe 6 months after FTX, it became very, very clear through a variety of different actions that the US regulators considered Jane Street to be a US person, which meant that if you wanted to build a fully compliant business, which Jane Street is like, that is what they do. It doesn't make sense for a firm as big as Jane to kind of take headline risks or regulatory risks in something like crypto and risk the rest of the franchise. And so, Jane Street at every point in its business kind of built the most compliant business that it could at the time. And when it became clear that the US regulators thought that it was, no matter what Jane did, it was going to be a US person because of US UBOs or whatever source of funding or things like that, then it became clear that in order to have a fully compliant business, you're talking about like trading spot commodities, which is like Bitcoin and the proof of work coins and ETH, and only trading derivatives on CFTC approved DCMs. And so basically only trading features on CME. Now, Jane Street obviously stayed in the business, and I am a big believer in the idea that part of the reason why the Bitcoin ETFs worked as well as they did is because of Jane's balance sheet. Like the back end where the cash to crypto lay was still free of payment, which meant that for these $1 billion creations, you needed somebody to send $1 billion off the door and then hope to get somebody back later on in the day. And the banks were still disintermediated and still are having problems. Between a combination of like SAB 121 and Basel 3, which still remains. That there are very very few firms in the world who could have managed $1 billion kind of free of payment creation. And so I do think that part of the reason why the Bitcoin ETFs tracked so well is because Jane Street was there. Jane Street and firms like Jane Street.
Yeah,
They're not
I
the
was
only
gonna say
ones,
the
but
two I think of are Jane and Virtu that I know were able to actually do this, and which I'm sure is your former mortal enemy in some regard.
I mean,
Where does
Doug's
this
celebrating his.
sorry, go ahead. Just one quick question. Where does the yield come from on Jito? I think it's 7.19%. I'm on the protocol's website right now.
Sure. Well, I'm happy to talk about Jito. So Jito's primary product is Jito Tips is the primary way that you can get transactions to land on Solana today. And so essentially what you can do is you can, send a transaction or a bundle. The bundle can't be broken up or sandwiched or front run. And you include a Jito tip. And so like if you want, if you're in the middle of, I don't know, pick your kind of network activity spike, and you want you want your transaction to land, you can use the Jito tip as a way of getting included. And so what Jito does is it takes the tips and then distributes it to validators and who eventually pass it on to stakers in the form of increased yield. So Jito tips, this is why Jito is over half of Solana's REV today. Jito will distribute over $1 billion back to validators just in the last 6 months. And so the Jito Solana yield comes from a combination of like the native emissions, like the native inflation rate, plus Jito tips and priority fees.
Right. So the primary payers of that yield are market makers and HFTs that need to get ahead of the queue and get transactions posted. Is that
Any market participants who want to get transactions to land on Solana. Like if you are, I don't know, trading meme coins or something like that, and you want to get early access, or you want to get like you're one of the first ones in, and yeah, and and you want to get those transactions to land, then you can just pay more in the Jito tips to include it.
it's a lot of yield to get ahead of the queue. A lot of value to being first.
Yeah, I mean, and it's I love these sorts of like really kind of niche market structure kind of discussions. I've written a bit on Twitter recently, Twitter X, whatever it is. Like everyone in Solana is talking about clubs in order to compete with Hyperliquid, but there's fundamentally this thing. Exchanges rely on price time priority, but because of the way the blockchains work, you can't actually use time as when you have distributed systems and you have kind of matching engines or validators who exist in many many different places of the world at the same time. You also have kind of blockchains that are where each of the blocks are kind of batch processing units. You can't get deterministic in terms of using the time as the priority. And for those of you who are kind of relatively new to this part of the world, like fobs are central limit order books. It's the primary like electronic markets that exist in TradFi today. So fobs rely, if you have a matching engine in one location and the central limit order book, obviously everybody sees the order book at basically the same time. So everyone's competing to reach, to hit the bid or lift the offer. And the main way to compete in those worlds is by time. And so all of the trading technology that has been kind of built over the last couple of decades have been focusing on this narrow dimension of time. Whether you're talking about like microwaves and fiber and FPGAs and things like that, it's trying to get trying to optimize for that one dimension. And you can do that if you have a matching engine in a single location that can do timestamps to the to the nanosecond, and so you can see which order came there first. But in blockchains, you can't really do that. And so people tend to compete on the price dimension. And whether price is like you're using a tip, you're using a priority fee, you're paying through the bid, or through the offer, or you're getting sandwiched by searchers. Like if like you set some sort of slippage on your order. So that's like you will eventually get your transactions to land, but somebody else is going to kind of intermediate that trade. And so trying to figure out like how you can create priority on a different axis than just price and time is like
Intermediate
is the
that
challenge.
trade is a euphemism for buy it ahead of you, then sell it back to you.
Well, that is
It's like
something that
HFT
happens.
trading,
Right. It's HFT. That's what it's about.
right? It's not the same. It's similar. I mean, in HFT trading, like there was meaningful benefit to like getting closer to like a co-located location, like you said, with fiber cables directly connected, or microwave towers, and like jumping ahead by like microseconds was like worth tons of money because of that exact reason. But there is benefit. I mean, I know a lot of people think of them as like vampires, but they're creating an efficient market and providing a service to, make more markets more efficient and liquid in a way, right?
Yeah, and I think that from where I sit, and obviously people can say that I'm biased, but market makers, the advent of market making firms, the advent of electronic trading, I think has undeniably created benefits for the entire ecosystem in the sense that like it's much, much, much cheaper to trade today if you are a mom and pop than it was 20 decades ago. Spreads are tighter, liquidity is much deeper, transaction costs are lower. Like it wasn't that long before I joined Jane Street. So I joined Jane Street in 2003, and it wasn't that long before that where they were still trading in fractions. And now you're talking about like spreads and kind of sub penny. Or you can kind of, if you're a retail kind of investor, you can trade at mid spreads now, and that's something that kind of has existed because there is a much deeper pool of liquidity. There's much clear kind of price discovery, and that price discovery is getting transmitted across the entire planet, kind of in as short a time as kind of the laws of physics will allow.
Yeah, I would say when I hear you talk about this, I think like one, you could create an ETF for tens of millions of dollars inside the spread in vast majority of equity products. But also like if you're wondering how efficient traditional markets are, like if you're somebody who's, a DeFi crypto native, look at a spread on a lit screen like a Coinbase or a Gemini and look at the fees you're paying. You're paying they'll say it's 0.3%, right? And then you look at the spreads. I mean, you're paying no fee on an ETF and the spreads are BIPs, and the spreads are not BIPs when you're trading on lit exchanges, right? So there are a whole host of things that like the TradFi systems definitely beat DeFi on for now. And one of them is
Uh,
liquidity and trading.
yeah, and this might be a bit kind of a convenient lead in into the conversation about tokenized stocks, but I do think that uh, it's weird to think about tokenizing a stock as like the first order benefit, just because, like, if you look at equity markets, particularly U.S. equity markets, which all the tokenized projects are kind of focusing on right now, like that is some of the deepest pools of liquidity that you'll find anywhere on Earth. Is like trading MicroStrategy or Tesla on, on a U.S. exchange right now. So, like, what additional benefit that you get in terms of price discovery and liquidity by tokenizing that stock? Like to the first order, the answer is very clearly not. Very clearly none. I think that there are other benefits to it, maybe in terms of access or the types of products that you can build or the types of, other sorts of capital efficiency that you can introduce for people who are only like digitally native. But in terms of like the actual liquidity that's available to trade US stocks, to your point, like there's just so much.
Is it a market expansion opportunity? Is it an access play for people on chain? Is it a 24/7 trading story? Like, what's the primary driver of the focus here?
Well, I mean, I think you'll have to talk to the tokenized issuers to figure out like what their specific sales point is. Like, I do think that. So we've seen just in the last, I think just today. So Kraken introduced X stocks. Robinhood has introduced tokenized stocks, and the main focus of those has been U.S. stocks for non-U.S. investors. And so, whether or not the benefit is like 24/5 trading or access to US stocks if you are kind of in an emerging market,
There's
you
a
know,
lot of demand for US stocks internationally and in emerging markets, including for Tesla.
def-
They love
I
Tesla.
definitely agree. I definitely agree. But there are a lot of vehicles available. If you're on the kind of the larger if you're on the institutional side, there's so many ways that you can get exposure to these stocks in other countries, in other currencies, at
Or
all different times of day.
yeah, even on Robinhood, for instance, there are ways to get access to Apple stock on the traditional. I was just looking at my list because I keep a running tally of who's doing what in tokenized equities. And Gemini on Friday announced they were launching tokenized equities for the European Union as well, starting with strategy.
Noah, why you've been paying attention to this closely? Why don't you just go through with like some of the announcements that were the biggest thing that caught your eyes over the last couple of days in the space, and then we can just rattle through them and get everyone's take.
Well, the big one has to be Robinhood. I mean, the Kraken is a pretty big deal as well, but Robinhood have come in this with a very big stick. And I've seen a ton of product launches, and I do pay attention to this. And this was the first one that I actually thought, wow, this actually could be something. Normally, I'm the one in the back going, I'm the one in the back rolling my eyes and thinking, so what? Now, this one was a very big deal. They announced, first of all, it was very slick. I don't know if anyone actually had a chance to see the live stream or the replay. It was a pretty slick production. But the content was actually up to the design of the event as well. And I won't go into the long list of what they announced because it's a lot, but there were three that stuck out to me. And not just because I'm in the European Union, but there were three that I think were offering something that I haven't really seen before. Now, one is perpetual futures are coming to the European Union on the Robinhood app. Now, perpetual futures, I'm sure everyone's familiar with what they do. They're a very popular derivative. Coinbase are going to be launching perpetual futures in the United States, which is also a very big deal. But the thing about perpetual futures is, one, they have not really been retail friendly outside of Asia, and two, the usability is key. I mean, perpetual futures for people who are not really versed in this is kind of confusing, a bit intimidating. You can lose a ton of money. One thing Robinhood does well is user experience. So the designs that they were showing for you just, drag along your limits and your margins and everything, it sounds pretty easy to use. And I myself might even try perpetual futures for the first time ever after being in this industry for God knows how many years. The second, again, just for the European Union, is what we were just talking about, tokenized stocks. And again, I've been on saying, why tokenized stocks? What really do they bring to the table? Access to equities has not been a pain point I've heard from absolutely anyone. There's no pain point there. And it seems a bit like just testing out the rails to see if they work. However, again, we get back to the usability issue. I might actually be encouraged to try to buy tokenized Apple stock one day if all I have to do is tap a couple of screens and I'm done. So again, usability issue. And then the third was the most surprising, and I actually laughed out loud when I heard it, and that is worldwide Robinhood blockchain. They are developing their own blockchain on which all of their tokenization efforts will run. And again, you can be the one in the back rolling your eyes going, why? But it's what Robinhood have done here, and here we come to the why, and this is the bigger thing here, is they are building an all-in platform that they want to control every single aspect of. And this is fascinating. Robinhood has been a platform for trading for some time. That's not new. Now they want to also integrate crypto into all of that in a fairly seamless way that we don't even know we're using a blockchain to buy an Apple share. We're just buying an Apple share on the app in a very convenient way. They are building the platform. Now, this is fascinating because we saw this with the internet development. Platforms end up winning because us, the users, were lazy and we want convenience. But it's more interesting here even because blockchains, in theory, were created to decentralize, to unbundle traditional bundled financial services. And here we are rebundling them. But in a way, this is not a defeat. It is a success because we are abstracting the whole blockchain part. Blockchain is not the important part here. What's important is better financial access for anyone, anywhere, and better opportunities in which to park your savings and or make money. So the abstraction, the platformization, and the rolling out of convenient usability to fairly untested parts of the world, that I think is the big message of today.
I think the larger value prop that these platforms, Robinhood and also Coinbase, who led with Base, they were the first to roll out their layer 2, and Kraken's following suit too. It's really a bid for the super app. There's been this mythical thesis of the super app on Twitter for several years now. It's where you do your payments, you do your trading. Elon is building a super app on X. It makes a ton of sense. You can do international remittances on it. That's what they're all gearing up for. One other opportunity set for tokenized equities are these treasury DAOs. So at Lumina, we're talking to these treasury DAOs that want to diversify their asset base. They've got a significant concentrated risk in their own token. But if you can enable them to programmatically invest in tokenized securities and algorithmically manage that on chain, you can have asset managers on chain that are doing this. That opens up another customer segment opportunity.
And one thing Vlad said in the product release today, which I thought was also specifically interesting, was the possibility. Again, it's not a definite announcement yet, but he hinted that it will be possible to take your tokenized Apple stock off of the Robinhood app. Now, this is a twist to the bundling that we were talking about, to the super app. Right now, you buy your Apple stock via your traditional broker and it's in custody, and that's that. It's not really going to go anywhere else. But if you could have a tokenized version, that can head off the app. Then we get into the, now this is why tokenized equities can matter. Because imagine tokenized Apple stock being used as collateral in a DeFi app. Or imagine there another app appears that allows you to use your tokenized Apple stock for streaming on Apple TV or something like that. I'm sure you can all think of much better examples than I am managing to do off the top of my head. But that's where it gets interesting, because what can a token do that a traditional share can't? It can be compatible. It can be programmable. It can be a lot more flexible than the equities that we know today have been. That's where the use case starts to get interesting, because just tokenizing equities, that's what they say, paving the cow paths. That's not that interesting. However, it's a good first step for what can be a new type of market.
One other additional point, I had a chat with Christine Moy from Apollo. She leads our crypto AI team at the Permissionless conference last week, and she brought up a point that you can now invest in ACRED. I believe it's Apollo's 40 Act fund, and you get access to it on chain. And then again, it's not financial advice, it's all entertainment. But what you could do is you can invest in ACRED. Now you're getting like a 10 to 12% coupon private credit fund. You pledge that it's collateral, borrow on Morpho, apparently at 1.5%. I don't know how that yield is out there. Maybe Thomas or someone can explain. We'll ask Raj. And turn around and invest back again in ACRED. So now you've got the ability to get like a mid-teens return on a non-mark-to-market private credit product. Now, the funding leg is you might get margin called on. So you're not truly doing a Warren Buffett where you've got a carry trade where both legs are secure, but that's the direction things are heading into.
Yeah, shout out. I saw Ram in person last week. Shout out to the Blockworks guy for putting on a great conference. Overall, my view is just this whole space. It just feels like it's it's almost like two masses coming together. It's like a DeFi and TradFi are like accelerating. Like I feel like the amount of announcements, whether it be Kraken or Coinbase or Robinhood, even Schwab, they're going to have crypto trading. Fidelity is a little bit slower, but they have crypto trade. Like everybody, it was like before it was siloed, like just 2 years ago, and now it's like they're sprinting together and it's getting faster. They're rolling downhill. It's getting faster and faster.
Internationally as well. I was reading today, South Korea, we know Japan's doing a lot. I was reading today that one of China's largest mainland brokerages is tokenizing shares via its international arm based in Hong Kong in 3 different currencies, including the offshore yuan. That is fascinating. And this is, again, not China mainland, it's their international arm. But they wouldn't be doing this without the okay from headquarters.
Yeah, I mean, all the TradFi guys that tell me this whole space is worthless and it's a bunch of beanie babies. I wonder what they're thinking over the last little few months to a year. Thomas, what are your thoughts overall on this? You came from one of those TradFi firms, but they at least believed in it. I'm sure you heard it all.
Well, I myself was a pretty big skeptic until I wasn't, and I have said in the past, like having a background in traditional finance could actually make it harder for people to understand, if you've come from that world, why this is so disruptive and why it makes a lot of sense. And Noel, to add to the Asia part, one of the questioners or the chat people my God, I'm such a boomer. Has reminded me that Bybit has released BuyReal today, which is where you can trade stocks on Solana by Jupiter and Camino as well. I think that weirdly, like Rom, like the ACRED example is probably easier just because there's a lot of like back end maintenance in holding stocks that that adds complexity to that adds complexity that might make it harder for some retail investors to actually understand what they're doing. Like, one of the big issues with tokenized stocks is like, what do you do with entitlements? Like, if there's a dividend or a stock split or a spinoff or some sort of corporate action, like what actually happens? Like in the traditional world, like exchanges set, like X dates, and there's admin or transfer agents who kind of maintain records of ownership. If you kind of take your tokenized Apple off of Robinhood and just kind of move it around within crypto, like I don't actually understand how that, like how you can establish or how people understand, like, okay, today, this Apple stock was entitled to a dividend, but I just moved it to somebody, and now either I've given my dividend to somebody else or somebody doesn't understand why, the it's down by $1 or whatever the Apple dividend is. And so it does create some complexities. If you're just investing in a tokenized fund where somebody else is managing it, then you don't, like a lot of that kind of back end is abstracted away. So, you know, again, it is a thing that I get why, the ability to kind of take tokenized equities and use it within crypto can be really powerful. But at the moment, like crypto money managers is, a very small fraction of traditional, uh, money managers. So uh, I get the use case. I think it still needs to be developed. And, in the same way that there's an education process that has to take place. I remember when the Bitcoin ETFs first kind of launched in Europe, and everyone was like, well, why hasn't it just taken off? This is what people wanted. And, but the issuers at the time didn't actually understand, oh, well, just because you list something on an exchange, you can't just go, like institutional investors can't just go and buy it right away. Like it has to get, it has to be put on an internal whitelist. There has to be compliance. Like they have to just look, like just because you list something doesn't mean adoption like goes hockey stick right away, but it does lay the foundation for innovation to come. In the same way when CME launched Sol futures, everyone was like, oh, well, these things aren't trading. Why is, or the forward curve is weird. Why is that? And then I was like, well, you have to be patient because, people are still trying to figure out the investment thesis for Solana. But if you have Solana futures, then you can introduce Solana futures ETFs. Then you can construct a forward curve because Solana futures ETF holders have to roll into the back, and so then kind of forces a curve to emerge. And once you have a forward curve, then you can do things like basis trading, and like it sort of builds on each other. And so you do need people to take the risk to kind of build the initial products that allow the foundation, that create the foundation for all of these future, what the world will look like. And I think we're all on board. Like, I don't know, my kids are never going to have to kind of worry about like which CSD their Apple is in because they're just kind of transferring it in a very, very easy way. But there is some stuff that needs to be figured out. It will get figured out.
Yeah, that's what it will get figured out, right?
It will get figured out.
There are two
And it's
ironies.
just better for the world. Like it's just better. It's easier.
The promise of blockchain was that it was supposed to replace the DTCC, right? This antiquated ledger keeping system in Lower Manhattan, which got flooded in 2011. It's supposed to be all electronic. So now actually we have a ledger in the DTCC and we've got a ledger on chain, and they're cross-referencing each other. I also read that MSTR is going to get tokenized on chain. And MSTR, of course, is an equity wrapper of Bitcoin, which is a commodity on chain. So this is evidence that we live in a simulation. I'm waiting for the sky to crack open. They say, congratulations, the simulation has ended. I think that one of the reasons why this is also happening, why there's great interest in it, is because crypto equities have been outrunning crypto tokens substantially. Take a pick: Coinbase, Circle, even crypto adjacent like CoreWeave. They're all outrunning crypto tokens. So the primary value prop of crypto calling a spade has been speculation. So you're able to offer a value proposition of speculation to these to degens on chain now. They can broaden the universe to equities in the 24/7 format, lets them scratch the itch.
Yeah, I mean, one way that you could look at what that statement that equities is outrunning tokens is this idea that the money that's available for equity investments is just far, far larger than it is for token investments, which is weird because, like there is a dominant narrative right now about RWA. And by the way, I hate the fact that RWA is no longer risk-weighted assets. It's real-world assets. It's a bit of a bugbear of mine. Yeah. But, there's this dominant narrative of like, how do we get, traditional assets on chain? When actually the opportunity set might be the other way, which is like, how do you get these digitally native assets in traditional wrappers? And that's one of the things that we're working on with GeoSol, the liquid staking token. But, like there is just so much more money um, sitting on the sidelines or sitting in funds waiting to be deployed in traditional markets than there is in crypto. Like,
And a lot of it is restricted as well. So many funds can only invest in assets that are traded on regulated exchanges. And even within that subset, there are many that can only invest in bonds or can only invest in ETFs or can only invest in a different asset class depending on the meta. And you're right, Thomas, that is where the big money is.
Good caveat. You've done this before. The other thing I wanted to say that we didn't really mention is, it's no shocking surprise. I don't know. They're going to do staking for, if you're depending on what state you're in and in the EU. And so Robinhood's getting into the staking game as well, which is huge. So I wanted to throw that out there. And then obviously, do we want to talk more about perps? Like, what do you guys think? I have a personal question. Like, do you think perps are really going to catch on in TradFi? Or do you think like they're going to lean still on the old school way of, rolling futures contracts? Or do you think like perps could be, the next big thing in TradFi even?
yeah, I think perps are going to eat the world.
Okay.
Personally, not financial advice. But there are risks. There are risks to perps that don't perps are fundamentally like it's just a cash settled derivative, right? And it is one that has no expiration date, which means that you have to kind of manage the margin as you go, and they're managing it kind of using kind of periodic margin call or margin calculation periods, and then you have to margin call and things like that. But fundamentally what it does is it allows you to kind of have this derivative that, as long as you maintain the margin, kind of replicates the value of spot. And you can do it in a cash settled way, so you don't need to set up wallet infrastructure and things like that. And you can do it with leverage, just depending on how you're accessing a perp market. So as you pointed out, there's lots of utility to perps that don't exist with futures or with dated futures. But there are risks to it. Like, the reason why perps work is because there's this liquidation mechanism such that if there is a large move in the underlying, then you could just get stopped out and you just lose all of your equity, which is hard to do in the existing market. And it's unclear what clearinghouses are going to do with perps. And I do think that, right now, one of the ways that I sort of look at exchanges historically is that perp exchanges do exist in a world where like anyone with an account or anyone with equity on that exchange was actually served as clearing members in a weird way. Maybe this is less true, not that there's like insurance funds and things like that, but like a while back, like years ago, OKX had this loss, and they socialized losses for everybody with an account, and that's functionally what like clearing members like would have seen. And so you do need to get the clearing piece figured out. You do need to get like no institutional market maker and no institutional kind of money manager is going to want to have to kind of set up a way to top up margin payments at midnight on a Saturday night. But I do think that like perps serve a lot of the same purpose as like zero DTE when it comes to the gambling, but You can also imagine perps being a much better kind of buy and hold thing, as long as you figure out like how you manage the margin, because you do have this thing where you don't kind of get front run on, on the futures rules. So then you're subject to like funding and periods and things like that.
It's funny you're bringing this up and you're talking about this, and it reminds me like SBF was in front of Congress basically trying to get perps and like using futures and derivatives to get through the CFTC. It looks like Coinbase is going to do it. And it reminds me of this tweet from Haseeb from this weekend, which is like, every time I use Cursor or Claude Code, I'm reminded SBF was a terrible exchange runner, but he might have been the GOAT investor. He invested in Solana, Sui, Cursor, Robinhood, Anthropic. I mean, if he could have held, that's like a staggering hit rate from the bottom. Right. And honestly, he seemed seemingly a pretty good exchange value. He just absconded with funds that he didn't have to invest in these things, right?
That's really credit to Amy Wu, though, right? Who left Sequoia, I believe, to join FTX. Let's give credit where credit's due.
Well, I mean, there's also survivorship bias. Like he was also long a lot of serum and oxy and things like that. Like, so
overall, though, like the MOIC, the multiple invested capital, I mean, that's EV positive. He's creating value. One interesting thing is like you never saw perps develop in TradFi because in Chicago, like the birth of these futures contract, they were tied to delivery dates, so you could manage risk in the real world. You can manage risk around physical commodities, such as the delivery of corn or hogs or oil.
Yeah.
And in crypto is like, well, you don't have any physical delivery. I don't need to manage that risk. Crypto is like, look, I just need leverage.
Yep.
And it's about speculation. So give me perps.
Fully financialized speculation.
Right.
Yep. And we do have to take into account that I totally agree with Tom that perps are going to find their way in traditional markets because it's a good product. It's just much less hassle. But it does exacerbate volatility. I mean, we've seen this with crypto when there is a massive liquidation event on the virtual futures, then it does exaggerate some movements in prices. And that's in Bitcoin, which is the most liquid crypto assets. Imagine perps in some less liquid stocks, for instance. It could definitely pick up volatility, or even some of the more liquid ones if the perp market gets big enough. Liquidation events are tricky, and especially if markets are not open 24/7, they could exacerbate volatility.
Yeah, and you do have this weird effect where like if you have perps done at a clearinghouse, the clearinghouse, if they have a liquidation mechanism, is weirdly like short gamma, like they're selling when the markets are down, which like anybody who's kind of watched markets understands like the short gamma trap is like very scary. And so like it depends on the skew of the perp OI and things like that, but I think that these are solvable problems, and I do think that the world is converging on it. Like the CME is introducing something that is perp-like. They're introducing these things that are like spot referenced futures, which I think are functionally like their equivalent of perps. They are going to do something weird, which is not weird. I mean, it makes sense given their existing market structure, where I think it's going to be a 24/5 market, but the perps are going to trade over the weekend, but they're going to treat the weekend as like a holiday maybe. So there might be huge margin calls on Monday morning when, depending on what's happened over the weekend. Like you can imagine like, if what happened a couple of weeks ago or a couple of Saturdays ago, causing large moves that people have to kind of prepare for. But broadly speaking, I think that there's a lot to perps that I like. But it's also worth mentioning, like, there are things that look like perps that have caused problems in the past. Like in the UK, something called CFDs, or contracts for difference. And CFDs are also used very, very commonly in like FX, particularly for like controlled, like not free-floating currencies, which are just kind of cash-settled derivatives. And people got blown up in trading CFDs to the point where the FCA actually banned retail from trading by CFDs. And so there are risks. A lot of the risks have to do with the amount of leverage that's available in the existing CFD market or the existing perp market. And you do have to manage like how you're going to handle liquidations and how you're going to handle margin payments, particularly on times when like FX windows are closed. But speaking as kind of a theoretical, if you were starting from first principles today, would you build a perps market or would you build a futures market? Like,
I think ideally you'd have both, because the advantage of a futures market is that you can look at contango and backwardation. The disadvantage is you have to bear roll risk there's a lot of information from seeing whether the futures price is higher than the spot price, like you have in Contango. It sends signals and information for people, whether to store or produce or to sell down current inventories. The idea of providing to the mass market access to perpetual swap derivatives is a big deal, right? Like if you sign up on, say, Schwab to write options, you've got to attest to that you have a lot of experience in this, 5 to 10 years. If you want to write naked calls, you got to demonstrate that. So this is kind of extraordinary. This is really extraordinary stuff. Like this is the high-powered leverage and velocity in crypto is coming to the masses. I wonder what the suitability requirements are for the product and what the user experience is to opt in and qualify.
All right, that's probably enough on the exchanges and all of that stuff. We're 40 minutes in, so let's take a break real quick before we move on. There's like 15 questions in here about the ETFs, so we'll get into that, and then we'll get into some macro. But before we do, let's hear from the sponsors that make the show possible.
Hey everyone, it's Matt Hogan, the Chief Investment Officer at Bitwise Asset Management. Each week I write a 5-minute memo covering the biggest topic in crypto. This week's memo is a special one. I look back at the 2025 predictions I made in December of last year and see which ones I've gotten right, which I've gotten wrong, and which are still up in the air. Do I still think Bitcoin will hit 200K by the end of the year? Check out my memo to find out at bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
Okay, so before we get into the ETFs, I'm going to share my screen in a minute. I want to this news actually. For a while, I thought it was going unnoticed, but I guess it was just the weekend. But basically, what Rick Edelman came out with. So Rick Edelman is there's hundreds of billions of dollars that use him. He's a legend in the financial advisor community. He's pretty much been very early to seeing the potential benefits in the crypto and ecosystem, Bitcoin, Ethereum, you name it. And he came out with a note recently basically saying that his firm is recommending a 40% crypto allocation for aggressive investors and as high as 10% for conservative investors. He's a full-blown believer. He was actually on, for anyone who knows, the Ritholtz guys, Ritholtz Wealth Management, they do a few podcasts, and he was on with them, and he was full-throated endorsement of crypto and Bitcoin. But yeah, I mean, this is a pretty aggressive stance coming from somebody who I'm sure there's a lot of clients here that don't like him saying this because there's still plenty of people in the TradFi world that I run into who still think this space is a complete joke and worthless. But I don't know. First thoughts here, Ram.
Look, if Bessent succeeds in becoming the next Fed chair, which seems like his motivation and goal, and he follows Trump's call to lower rates to 1%, you're going to see digital assets take off. And then you'll see them roll over, just like you saw in 2021. So this is really quite something. I mean, I kind of have to read this 3 times to believe it. I mean, this is we should get Rick on the show and see. Let's talk, kind of poke it and see if it's real.
I was just going to read the last sentence. Basically, it's like until this is something we've talked about. Like until the last couple of years, it was like, as a fiduciary, you were taking a real risk by recommending clients invest in the space, whether it was Bitcoin or other digital assets. I think that has changed. And Rick is saying it's been completely flipped on its head as far as he's concerned, is basically, are you a fiduciary serving your client's best interest, or are you simply an order taker avoiding difficult conversations? He's basically saying now owning crypto is no longer a speculative position. Failing to do so is. So, and that makes sense. I mean, if you just look at the total market cap of the crypto space or Bitcoin specifically, and you hold a globally diversified portfolio, it's telling you should have a couple percentage points in crypto, or at least 1 percentage point in crypto in some regard.
Well, he says crypto, not Bitcoin, right? Most crypto tokens have gone to zero. Bitcoin dominance has been increasing. And look, part of it is he can sign up more customers for his crypto education course to these advisors. In a way, it's a call to action. If you want marketing shock value, here it is. I'd also say a message like this would have landed better in 2023. Like maybe we've got 9 to 12 months to go in this cycle. Or if you talk to people like Michael Terrapin, he'll say Q4, which is 6 months away.
I'll take the other side in that 2023 comment. I think once Trump was elected and once Gary Gensler and Biden was out of the White House, that's when it became part of the left tail of the risk of anything crypto or Bitcoin related went away. So that could have been, yeah, I think sometime after the election, it made sense to start saying you really should be considering owning this.
Yeah,
And again, you could
one
argue
thing-
there was no risk, no reward, but go ahead, Noah.
True. One thing to realize here is when I first saw the headlines, I was thinking, what's the big deal here? Because Rick Edelman has been recommending crypto for years. I remember being on a webinar with him back in 2018, back when he was at CoinDesk, and he spoke at many of our events, and so he even wrote a book about crypto. So Rick Edelman recommending crypto is not the news. The news is the 40% recommendation. He was about 1 to 2% was his recommendation back in 21, 22. So I think that is the big thing here. And when it comes to the timing, again, RIAs don't tend to think like that. They tend to be long-term, they make long-term recommendations for their clients. They're not going to recommend go in and go out. So the fact that he's gone from 1 to 2, which is the standard, you're right, James, that's what we hear most places, to up to 40, that is, as
I
we're saying,
agree.
that's the big deal.
And it's odd because, as you pointed out, Noel, an advisor is supposed to develop like a strategic asset allocation that's relatively inflexible. So is he saying that these assets should be hodled versus traded? That's not my view, especially like crypto. I mean, these are like narratives and memes and momentum and being early to a concept. You know, it's a very different approach. So it is striking.
Yeah, I mean, I would also say I think Scaramucci, I think this is Scaramucci's story. He was talking with Saylor about his book that he was writing, and he was recommending a 5% allocation. And Saylor was like, well, how much do you own? And it was like his allocation was like in the 30 to 40, 50% range, right? Even higher. And they were like, well, you should be, practicing what you preach. And I will say, I'm in the middle of writing a book. We've interviewed a lot of people in this space. And for the vast majority of people we talk to, they say 5% allocation, maybe on the high end. I've heard some people go as high as 10, mostly in the sub 2 to 5% range. And you ask them, okay, that's what you think should be recommended to clients. What do you own? I haven't talked to a single person that was below 20% that is like a believer in this space and recommending people allocate it. So I think there's like a dichotomy with like, okay, if we tell them to only put 2 to 4% of allocation in their portfolio, it's not the end of the world. It's safe and secure, but I fully believe it, and I'm going to allocate a huge chunk to it. And I think this is kind of like Rick seems to have a little bit of jumped the shark here and was like, okay, I'm not going to keep recommending these single-digit percentage point allocations.
Yeah, he's also not saying what crypto is. Exactly which assets is he talking about here? Yeah,
he's predominantly Bitcoin. Yeah, based on what I've heard. Like, he definitely is a Bitcoin believer, but he also believes in other cryptos and stuff. What we've been talking about here.
Got it.
I think there's a couple of things about this that I took away from it. One was that essentially, I saw him speak very briefly about this, and his point was that as life expectancy extends, then we need to think about risk differently, and we need to extend along the risk curve for longer than we have in the past. So I think that's probably just true. And the second thing is, like, if you have a zero allocation to Bitcoin, then you're essentially short, which I also think makes sense. I don't know what the optimal number is. This is not my area, but I do think kind of contextualizing it with, if you're an RIA, then you need to take on more risk for longer than you have been conditioned to. I think probably makes some sense.
Look, the guidance of Ray Dalio, who I think is a bear and totally offsides around the end of the US dollar and this debt stuff. But the general idea of having 7 to 10 uncorrelated return streams with positive expectations is the right approach. That strategy is why Millennium and Citadel and others have done very well over time.
Yeah, and Laura Shin just made a good comment, a good post in the chat. He said a lot of people allocated 5% and it grew to 40%, which is different than allocating 40% out the bat, but which is very fair assessment. I don't think most people are going to be like investing and all of a sudden just plopping 40% of their entire assets into crypto. But
CoreWeave, Circle, they've outperformed Bitcoin in a few months. You've got Mag7 there's a lot of great opportunities out there. Uranium,
Robinhood,
banks, Robinhood. So it's like there's a lot of interesting things in the world. I'm kind of surprised again.
Well, I wonder if he would consider some of those things you mentioned to be related to crypto investing. Like I would argue if
in
you're
the
investing in
basket.
crypto, a Coinbase, like that is investing in crypto, not necessarily like I think it's a broad umbrella.
Yeah,
Just
and we
FA
remember back in it wasn't that long ago, gosh, all the institutional investors, the Goldman Sachses, etc., were doing the calculation, Morgan Stanley, doing the calculations whereby if you put 1 to 2% in Bitcoin of your 1 to 2% of your portfolio in Bitcoin goes to zero, you haven't lost that much, goes up 10x, you've made a lot of money. Well, that's a different equation at 10, it's a different equation at 40. So I think the news here is the all-in allocation.
Yeah, you got to be believing in significant dollar debasement. We've probably killed this topic to death now. We can go on, but
Yeah.
quite interesting to see that.
So on Friday, we updated our odds. We talked about this last time. Basically, we think the spot Solana ETFs, all of these ETFs are going to get approved in 2025 for the most part, with the exception of Sui, Tron, and Pengu. There's some questions. I think if you have a CFTC listed futures contract, which there's plenty on Coinbase right now, you're probably going to get an ETF. A lot of people are asking. So Rex Osprey on Friday, basically, I talked about this on the episode on the show before. They went through this really convoluted way to kind of use a Cayman Islands subsidiary and using this unique structure that would get around the SEC rules and technically allow them to offer exposure to spot Solana staking and spot Ethereum staking. The SEC kind of said, no, we have a problem with this. And that went back and forth behind the scenes from what we could see. And then late last week, we got kind of a letter that basically said the SEC had no more comments or concerns at this time, which makes it seem like it's going to go live. Rex Osprey has tweeted that they're going to go live soon. There's rumors now that it's going to go live on Wednesday. I don't know that for sure, but if that letter from the SEC was saying it's okay, it's going to go live Wednesday. We're going to have a Solana staking exposed ETF on the US potentially this week. That said, I want to be very clear. This is not like pure exposure. There's going to hold some securities and other ETFs in there as well. But what matters here is that it's kind of, in my mind, similar to when we got the Bitcoin futures ETFs. Like it wasn't the spot product. It wasn't the be all end all. It wasn't the pure simple exposure that people ended up desiring for its low cost and simple structure. But this is exposure. And what it does tell me that, as I've been saying for forever, we're going to get staking in ETFs here. Ethereum ETFs are not going to be far behind. I think the ones that are existing are going to be able to stake before the end of the year. I think all these products are going to launch, and it looks pretty damn good. So yeah, we'll see in the next couple of days here, but we could see a product that offers Solana staking yield.
James, I have a question. This doesn't offer direct exposure to Solana. When do you think, in your estimation, we'd get that, and what's the holdup meanwhile?
Well, it will hold, like, I think don't quote me on these exact numbers, but I think it's going to hold 40% in the Cayman subsidiary of Spot Solana, or like some number is going to be owned by like other Solana ETFs potentially. It's going to be rather convoluted to meet all these like legal and regulatory requirements. I don't want to get too bogged down in the weeds, but it's going to give you mostly pretty damn close to Spot Solana exposure. We don't know the fees yet. We'll see all those when it goes live. But for the pure like 1933 Act, it holds nothing but Solana or liquid staking tokens, which Thomas can comment on maybe. That's going to happen this year. Will it happen next month? I don't know. Maybe. The SEC is working towards this. Like one of the things that I'm looking at is like I know I said CFTC futures contract. I think if you have one of those, you're going to get a spot product at some point, because if you don't approve an ETF for spot and it has a futures contract, you can't deny a futures ETF, right? Because there are CFTC regulated futures contracts. We know that. And then if you get a futures ETF based on the grayscale precedent, you kind of have to allow a spot product to go live. So maybe you need some sort of like timeline of length of existence, or some level of open interest and volume, or some size of the underlying asset, some percent of float, all these things, and or like US dollar trading pairs, things like that could matter to the SEC. But as long as you satisfy whatever framework the SEC comes up with, which is like what we're trying to understand what might come out of this, it's going to get approved. And I think the vast majority of these things have been applied for are going to get approved this year. Will all of them? I don't know. But over a long enough time frame, you're looking at the top 20 tokens. And as long as you have a decent enough size, your float isn't like extremely low, you have a futures contract, who knows? It's going to be some combination of like end functions and or functions. I don't know exactly what it'll look like. but that'll be what we get. And at the very least, we're going to see approvals by October, but it could happen this summer.
I have no interest in Litecoin, Hedera, Polkadot. I think we could probably leave them for dead. Tron could be a sleeper, though, given its prominence in offshore USD settlement. That could be
Well,
quite.
you might be able to get direct exposure to Tron via an equity soon.
Yeah.
You might not need the exposure to Tron, the token, which would live inside the ETF.
So Thomas, I'm curious. Rom started out the show asking about like the staking yield of Jito, right? I would argue, and I have argued, offering Solana exposure without staking is like not great, particularly when the yields are, like you said, north of 7%. It's not great for Ethereum. I would argue it's probably worse for Solana. Can you just talk about like how you see this? Like, would you like to see all of these just hold like Jito Sol, or like using some staking validators? Like Canary has filed a product that's going to partner with Marinade, who will like basically diversify across 30 different staking providers. And that might be good for like diversification. But I'm curious, like how you see this whole space potentially playing out in the TradFi DeFi overlap for staking exposure.
Yeah, well, I should say, first of all, in the interest of full disclosure, Jito Sol was named explicitly in the Rex filing. And I do think that, so if you have a thesis, as I do, that the optimal product that you could design for users today would be 100% staked. So I think that's relatively uncontroversial, just because like you're talking about kind of yield maximizing for users. Then 100% staked is kind of the best design that you could have inside an ETF. I don't see any way that you get to 100% staked without using liquid staking tokens, especially for Ethereum, but also for Solana. And Ethereum and Solana have different characteristics that make staking kind of harder or easier for one versus the other, or creates a different risk profile. Like Ethereum is a little bit riskier just because they have a longer unbonding queue, which is like when you request to unbond your liquid staking tokens, when you get your ETH back. And also there's this weird thing where if everybody heads for the exits, like if everybody kind of unbonds a liquid staking token at the same time, the queue for the ETH unbonding can extend. Whereas Solana is deterministic in the sense that like if you unbond your liquid staking token, you get your Solana back at the end of every epoch, which is roughly about 2 days. So generally speaking, we have been speaking. So there are 9 filings. We are in very, very active discussions with 8 of the issuers. And not only the issuers, but everybody throughout the ETF ecosystem, because you can't just get the issuers. You need the custodians, you need the index providers, you need the APs to actually understand like what would be difficult about facilitating or managing using Jito Sol or any liquid staking token inside an ETF. And I think broadly speaking, like the main thing that we're waiting for now is like what guidance will come not only from the SEC, but also from the IRS. And so helpfully or potentially unhelpfully, Van Eck explicitly listed liquid staking tokens as a liquidity solution inside their ETF. We'll see what the SEC comes back with. It's possible that the SEC comes back and asks them to strike that language because they don't want to think about liquid staking tokens right now. Or it's might be possible that they come back and ask for clarifications or don't say anything about that. And given kind of how broadly all of the language in the ETF filings have been, we could imagine liquid staking tokens appearing in other filings as well. And when it comes to the IRS is a pretty key player here because we don't actually understand, or there's no rule set around how staking is handled and whether it's permitted inside a grantor trust, which is the primary kind of structure that the 33 Act funds are applying under. And if staking is not allowed under the grantor trust structure, then what ends up happening is the issuers are going to have to decide whether or not to restructure it as a partnership or as a corporation. And a partnership and corporation has like different tax rules that make them kind of structurally either more annoying or worse, depending on your feedback. Like the product is a 40 Act, but it's structured as a C Corp. And one of the main kind of questions that people have is like, how taxation is handled under the C corp, and you have this weird feature where the tax has to be taken out of the NAV, which might make it look like it's underperforming just because of the way, like, if Solana doubles on day one, then the NAV is only going to increase by, something much less than 2,
Yeah.
which might be
60% of it theoretically. I mean, let me just say, Thomas knows ball, because the number one thing that's holding up anything right now with staking being these ETFs is how the IRS is going to handle that income. Is it good income? Good as in a quote of like how they handle this, allowed essentially. I've heard people try to make the argument that it's not necessarily income in the sense, because it's just like a payment in kind and there's no like dollars coming in. It's just holding this asset and it's getting more of this asset. I don't know if that's going to hold up with the IRS. I think the IRS has something different to say about that. So this all comes down to, part of the reason we don't know about timing is because of exactly what Thomas was just getting into. The main concern, I think the SEC is ready to go. They're fine with this, right? They're ready to allow staking. Some regards, maybe they'll allow liquid staking. Any of this can change over time too. I mean, look, the Ethereum ETFs launched without staking. It's coming back. If they don't allow liquid staking tokens, it's probably something they can come back to and get in there. In kind wasn't allowed, it can come back. But right now, it's really about these issuers figuring out a way to like fix this thing in the wedging in the hole of like what's allowed from a regulatory perspective. And it will get sorted. There's enough money and enough people trying to do this, it'll get sorted.
Yeah, and this has just made my entire appearance here. Like, it's 10:30 here in London right now, and you saying that I know what I'm talking about, I'm done for the night. But I will say, like, like, liquid staking tokens are a pretty neat solution to this whole question around like liquidity on redemption risk and yield optimization. And we'll have to see what they have to say. There's also a possibility that I've heard, which is that the SEC. So I think that the SEC has to rule on staked ETH before they have to rule on staked Solana. So it's possible, I guess, that they come up with a rule set for ETH and just apply them to Solana, which would be a little bit weird. But if there's, so under the 33 grantor trust, you're also not allowed to have something that looks like active management. So if you allow staking, then you're like, well, how much of this can I stake? Like, if the issuer takes too much discretion on that, then it runs, the risk of kind of going afoul on some of this kind of active management stuff. So I think there may be a rule, maybe a world where they allow staking, but only up to a certain percent of the asset. And if that's the case, then a 100% liquid staking token is just a far superior product. And we have spoken with a number of issuers who get that. And, like, weirdly, like, from where part of the reason why I'm attracted to liquid staking tokens is because liquid staking tokens actually carry a lot of the characteristics of something like an ETF, in the sense that, so the liquid staking token, for those of you who are less familiar with it, it's just basically a deposit token that says that you own some amount of Solana that is being staked. And the yield that you're earning from your stake continues to accrue within this deposit token. And so essentially you have this thing which provides economic exposure to the underlying asset plus the increase in yield, but abstracts all of the middle and back office kind of mechanics. You don't have to claim the yield. You don't have to do anything. You just hold the token and it accrues within the yield, within the token. You have this liquidity flywheel because there's essentially primary and secondary market liquidity, because you can mint these tokens or you can burn these tokens in the same way that you can create and redeem ETFs. And because you can create them in kind, it carries a lot of the tax efficiency that ETFs carry. And plus, GeoSol and other liquid staking tokens have the benefit of being able to be used as collateral at a number of different kind of prime brokers. And so you can post GeoSol, for instance, at Falcon X. You can use it to kind of secure the rest of your portfolio. Or I think, Ram, you were talking about this earlier, like, you can use it, take the GeoSol, borrow against it, loop it up, lever it up, things like that. And as a way of kind of increasing yield. And there's, it's possible to do that on numerous platforms on Solana today. So generally speaking, like, if you have this product, the liquid staking token, that you can use to maximize the yield, and you can meet redemptions because you can burn it or you can sell it or you can convert it, then it does feel like, you get something that looks pretty close to an optimal kind of product for users.
Well, I
And
guess we'll find out soon enough if it's how optimal the SEC thinks something like that will be.
But everyone else, like the custodians, we've got them ready. The index providers, we're getting them ready. The APs have all indicated that they could support this. So, yeah, we'll see what happens.
All right. We're going over a bit on time here. Noel, Ron, do you have any comments on the ETFs and Jito Sol, or should we move on to macro?
I think
for 5
market
minutes
top
before
within
wrap
12
up?
months. No later than 6 months after the last ETF in your list launches, maybe 3 to 6 months, but enjoy the ride. If the Fed cuts rates to 1% as Trump wants, and it looks like Besant's really angling like for a Fed chair role, and it looks like he'll do what Trump wants, then you're going to see one hell of a rally.
Yeah, I mean, here's
one hell of a sugar pump, right?
here's a letter that Trump sent to Jerome Powell, basically saying, Jerome, you are as usual too late. You have cost the USA a fortune. Continue to do so.
Look, you're at all-time highs. The economy, stock markets are all-time highs. Like, we're not late to the party. Like, where's the economic weakness? Initial claims haven't gone up. Earnings growth is double-digit year over year. Disinflation is taking place. Like, so I really want to see what happens in the next Fed chair announcement. And, is there a shadow chair? And, I think, Noel, you're talking about this before the show around shadow guidance.
Yeah, and we have here, ladies and gentlemen, the sitting president of the United States actually engaging in forward guidance, and the market seems to be paying attention to him, which is totally surreal.
I think the markets, it's more people are off sides. They got to get back in the market. The benchmark's going up. They're underinvested, so they got a performance chase. I think that's the primary dynamic, just creating this grind up. The Iran-Israel thing kicked people out of the market again, then it went away. This is a performance chase that's taking place. There's so many boomers relying on T-bill income that, and this is a boomer economy, that keeping rates where they are may be just fine for spending. I don't think you need to cut at all, actually.
Yeah, I'm on the record as saying I don't think we'll get cuts this year, and next year, who knows? A lot depends. But you're right. You're so right, Ram. The rates they don't really matter. What matters is the fiscal stimulus. We've argued about that a lot, debated about that a lot on this show. And even the Atlanta Fed today, I think they have the GDP forecast for Q2 at 2.9 or something like that. That's pretty healthy. That's really very healthy. And financial conditions are loose. So, you loosen them anymore, you're going to get more inflation.
1% rates created the housing bubble that ended badly in 06, 08. That was the response to the implosion of the dot-com bubble, which was a narrow sector of the economy, even if it was a big part of the market cap. And then we had this whole experiment with quantitative easing. One would hope that we've learned from that. I don't think you need to go back to 1% rates. Arguably, we didn't have a recession from raising rates and escaping the 1% rate environment. As you know, Noel, they called that a liquidity trap. Can you escape it? One reason why we didn't have a recession is you had massive stimulus that accompanied the raising of rates, trillions of dollars of stimulus. We don't want to do that again. So we had this graceful unwind with 8 points of inflation that's now behind us. Let's just keep rates in this new normal, which was the old normal.
So 2 things first, real quick, Noel. One, I do think we get 50 bips of cuts this year. That's my guess. I think we get 50 bips of cuts. I think probably later in the later half. I don't think it's going to come in September necessarily. And the other thing I would say, the arguments for why you should cut, I tend to agree with you. I don't think we need to cut. There's nothing breaking the economy. Yes, the labor market's a little bit softening. The housing market just looks completely disjointed in many places that probably could benefit from some cuts. But the real reason is what Scaramucci was saying last week. Like, inflation is 2% right now, arguably lower if you look at inflation, and we're so far above that. Real rates are rather high if you trust what's going on with inflation. So you could argue that we are restrictive on that sense, but the rest of the macroeconomic data, from my point of view, doesn't necessarily support needing to cut, at least
real rates are high because productivity rates are high. Real rates are a good measure of the return on capital for the economy writ large. We have a productive economy. We want real rates to be high. You want to live in a world where the return on capital is attractive.
Yeah, what are your macro thoughts, Thomas?
Well, I'm much less of a macro person than you guys, but I will say, for those of you who who kind of might not immediately grok that like decline in rates might cause inflation in asset prices. It's mostly like if you have something that's USD denominated and the USD kind of depreciates, then kind of the left-hand side just has to go up. And anybody who's kind of familiar with like, I hate that I'm talking about this in the context of dollars, but anyone who's kind of looked at quanto products in the past, like understands like what if impact that has when kind of the value of the right-hand side goes up or goes down, then the left-hand side just has to go up. And if everything's denominated in dollars, then everything just kind of goes up in dollar terms, but it might not go up in kind of real terms. And I think that the other thing that like everyone keeps talking about like the Fed and rates, but I think that the largest impact on kind of um, the mindset of the government was actually in the reaction of the bond market to some of the earlier rhetoric. And so I think you do have this world where like they might push for rates, but if it causes like a downturn in bonds, like if everyone starts selling bonds, then like the effect of a rate cut is not going to be is going to be very different than what has historically happened in the past.
Totally agree. And, there's quite possible we get rate cuts and yields go up further, or it's quite possible we don't get any rate cuts and yields come down anyway. And it's the yields that matter for the interest payments on the deficit, not so much the rate cuts. And it's also interesting to see that the United States right now, amongst all developed economies, has the second highest interest rate level. I think we're just behind Taiwan. Everyone else has lower rates now. And yet the US dollar has had its worst first half since the 1970s.
I mean, we were talking about this kind of before the show, but like, we've seen some of this posturing in other countries, like most recently in Turkey with Erdogan, where he kind of very publicly disagreed with his kind of a succession of central bank governors around the effect of rates and inflation and the currency. I think that like in a world where the Fed actually doesn't have independence from the executive branch, like I do think that changes the way that you look at um, look at investing in U.S. debt in a way that is kind of divorced from whatever the Fed target rate is. And I think that might have been what we saw kind of earlier.
Where the dollar would be if they had been cutting rates. I mean, the dollar would not be worth as much from like interest rate parity and attracting foreign capital. But a lot of this, I think, is that people accelerated imports. When you import, you're selling a dollar to buy some other product. So, maybe we've seen the worst of the dollar declines, especially since rates still remain elevated.
I mean, if you look at Trump's rhetoric and what's going on, he wants to go back to a pre-1951 world where the Treasury and Fed acted in lockstep. I mean, just look at the note he wrote that we had up on the screen. He's concerned with how much money the rates are costing the U.S. government in dollars, and like, I guess that could matter, but like that's not the Fed's mandate. The Fed's mandate theoretically should be, full employment and keeping inflation under control. But now it's also funding the U.S. government. Theoretically, are we going to get a third mandate from the Fed?
I agree. There's more liquidity than ever. And Noel, you've been focused on the fiscal dominance thesis. You see it playing out with a big, bold, beautiful bill. We should see how that resolves in the coming days. And now you've got tax cuts for sub 150K. By the way they're scoring these budgets, that they're saying that they're deficit neutral by assuming they expire, it's all made up funny math. It's all hocus pocus math. It's like nonsense math. Like deficits are going up and they're telling the American people that they're not. There's like no responsibility, no accountability. And that's bullish. That's actually bullish.
And there's worlds where like a weaker dollar is good for exporters. Like you're paying less and you're receiving more. And so if you actually do want to bring manufacturing back on shore, then this is one way to do it. But
it's bullish short term. But yeah, no, I agree. I mean,
like Americans are consumers, they're not the exporters. Or that's been the way that the world has grown.
Technology services, we export NVIDIA, Google and Meta were getting taxed from Canada and Europe, etc. But
sure, sorry. I mean, like Americans are Americans are consumers of finished goods. Have been for the last since the end of the World War II. And so, yes, if you want to bring manufacturing onshore, then this is one way that you can accomplish that. That's kind of divorced from the impact of on deficits or deficit spending or however. But it does force you to kind of go back to, as James was saying, like a different time in history.
All right, we're coming up in 80 minutes. Any final thoughts, Noel, on the macro or anything else we haven't discussed, or should we wrap up?
No, we got an interesting jobs report out this week. There have been signs of some softening, but it still looks pretty robust if you're going by the unemployment claims, which we get every week. But again, who knows? The market seems right now priced for perfection, and all it would take is one very nasty surprise, which could come either in the jobs or in any of the many inflation indications we're going to be getting before the next Fed meeting.
We have a lot of jobs data coming this week, 5 different economic reports all around labor markets. I think markets keep grinding higher. You're going to see the term all-time highs again and again and again for at least the next 20 to 30 days, my expectation.
Thomas, any final thoughts?
I've really enjoyed this. I've learned a lot from you guys. This is a pretty cool thing you guys found on.
And we from you, Thomas.
Yeah, thank you for joining us.
Yeah, this was great. Thank you.
All right, guys. You can follow Thomas on Twitter. His handle's right there, Thomas UHM on there. Thanks for joining us for this episode of Bits and Bips. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, everyone.